Bright and early on Thursday, MBS were up 14 basis points on the day. Stocks were winning again, being up 21 points real early. While most of the morning economic data was stronger than expected, bonds are more focused on the jobless claims as a harbinger of a potential turning point in the labor market. Jobless claims came in at 263,000 on a 249,000 forecast. It was 261,000 previously. Retails came in big. Came in up 0.3% on a negative 0.1 forecast. Everybody keeps spending that money, and it was 0.4 previous. Philly Fed came in at negative 13.7 on a negative 14 forecast. Import prices came in at negative 0.6 on a negative 0.5 forecast. It was a positive 0.4 previously. And the New York Fed Manufacturing Index came in at 6.6 on a negative 15.1 forecast. It was negative 31.8 previously. So we got a lot of information in both directions, some of it making it seem like we are not in a recession or heading into a recession, but other things showing weakness. Last week's biggest bond rally occurred on Thursday, immediately following the release of the highest jobless claims number since late 2021. Exactly 1 week later, we are looking at the exact same number in this morning's data. It has been enough to completely counteract the generally stronger message for the other economic reports, as well as a hawkish lean in the ECB announcement earlier this morning. Hats off to the Federal Reserve Chairman Jerome Powell, who delivered unto us the most hawkish rate hike pause in memory. In his presser that followed, he was clear that there was some further rate hikes in store and that the process of getting inflation back to the 2% target has a ways to go. I don't know how many times this guy has to say that it is a 2% target and they're just going to keep pounding until they get there, but whatever. So why the pause? As central bank's FOMC statement tells us, it allows the committee to assess additional information and the implications for monetary policy. They see a Fed funds rate of 5.5% at the end of 2023 versus 5% in March. The outer years were pushed up as well. At the press conference, Jerome Powell telegraphed that the Fed is going to hike in July by referring to June as the skip and characterizing the July meeting as live. Fed fund futures see a 65% chance of another hike in July, but are assigning a low probability for anything further. At some point, we're probably going to have a recession. Historically, tightening cycles have triggered recessions, and this one has been the most aggressive since Paul Volcker's dramatic moves in the early 1980s, which caused the deepest recession since the Great Depression. While it is always tempting to think that this time is different, it probably isn't. Separately, the European Central Bank hiked rates by 25 basis points this morning. Despite a slew of other economic data that was stronger than expected in the 8:30 time slot, the bond market was perfectly content to focus on yet another instance of highest jobless claims since 2021. As far as we're concerned, that's the highest claim since 2017, considering 2021 still on the way down from the post-COVID stratosphere. As far as the market is concerned, that's a potential early indication of a shift in the labor market, something that could solidify a downward trend in inflation. I don't know how many times I got to say it for people to realize that the Fed does not care if we go into a recession. They do not care. All they care about is employment and inflation. At the end of the day, MBS won by 41 basis points. Stocks won 53 points. So winners all around at 100.23. That puts us in yet another new range that is bordered by the 25-day moving average on the bottom and the 50-day moving average, as well as the 200-day moving average as a ceiling about 12 basis points above current levels. So got a pretty high ceiling there and a couple of floors. Also saw some information today that I thought you might find interesting. Currently, 33% of all homes and rising are sold over ask price. So basically a third of all sales are selling for more than they list for. So it is still a bidding war out there on a lot of homes. Also, the average loan to value of homes of loans out there is 42%. So basically, average equity is $231,000 as a cash out refi. So on average, people have $185,000 worth of cash they can pull out. We also got a post from our sponsor at wellthatmakessense.com, another in the series from Alex Hormozy. If your life sucks, the easiest thing to do is change your environment. So basically he's talking about if your life sucks, the easiest thing to do is change what's going on around you, moving to a different place, changing your job, changing anything, change something, because if your life sucks, you really have nothing to lose. So you might as well change something.